Welcome back. You're watching Business Morning, the first edition for the week on Channels Television. On the program now, we're going to be looking at the state of the economy with particular emphasis on recent development. Like last week, JP Morgan actually brought out a release stating that there are plans to assess Nigeria's government bond index on its emerging market. And after there's going to be an assessment of 3 to 5 months, after which probably Nigeria will be removed. Now, the reason why JP Morgan actually came up with this was because it said there was a shortage of liquidity in the market, in the forex and the bond markets. Well, to talk more about this, I'm being joined on the program by the Chief Executive Officer and Managing Director of Cowrie Assets Management Limited, Mr. Johnson Chukwu. Mr. Chukwu is also a financial analyst. Mr. Chukwu, good morning, and thank you so much for coming in.
Good morning.
So let's talk about this, this index. 3 years ago, when Nigeria was listed on JP Morgan's government bond index for emerging market, what were your thoughts? Were you excited about it?
Yes, absolutely. If you see what happened immediately after the listing, Nigerian bonds became very attractive to foreign portfolio investors. And we saw a deluge of bids by foreign portfolio investors for Nigerian local currency debt instruments. And that also helped the economy in some ways. It helped stabilize the exchange rate. It helped increase our reserve, foreign exchange reserve. And that gave us some level of boost. And basically, when foreign portfolio investors are interested in your fixed income instruments, that would eventually dovetail into interest in other segments of the economy because your instrument become attractive, become a subject of discussion in global economic space. And people begin to, in the course of discussing your debt instrument, they also discuss the equity instrument and may even discuss foreign direct investment in your economy. So it's good. And if you look at the countries that belong to that JP Morgan emerging market bond, local currency bond index, there are 18 countries and only 2 from Africa. And if you look at all the big countries are there, and all the major countries like Indonesia, Philippines, are all part of that. You look at Brazil, India, China, South Africa. They are a group that Nigeria should ordinarily belong to.
So out of the mint now, Nigeria was the only fortunate one to be on that index?
Yes. But no, Indonesia is there.
Okay.
Indonesia is there, and Philippines is there. Of course, Indonesia, Mexico is also there. So you have the main countries and the BRIC countries are part of the JP Morgan bond, local currency bond index. So it's a group that naturally, as the biggest economy in Africa, as the most popular country in Africa, we should belong to. It has helped in its ways to help stabilize the exchange rate when Nigerian instruments were very attractive. And we have to look at what led to JP Morgan saying they put us on a negative watch. Because sometime in December, the central bank imposed a 0 open position limit on banks. That automatically sterilized the interbank market. And without liquidity in the interbank market, you cannot have liquidity for foreign portfolio investors that want to exit in your market. Remember that you have already said that foreign portfolio investors or all such demands should be sourced from the interbank market. They can't source their funds from the CBN market, autonomous Dutch Ocean market.
Okay, then will it be safe to say that it was too soon for JP Morgan to decide that there was a shortage of liquidity at the forex and the bond market?
No, at the time they came up with that decision, it was clear there was a huge shortage of. Sometime between the time the CBN took that decision to have a 0 open position limit and the time it restored 0.1% open position limit, there was almost no liquidity in the interbank market. And if you don't have liquidity in your interbank market, foreign portfolio investors are invested in your instrument. Remember, like I said earlier, remember that the only window, legitimate window for them to exit the market was the interbank market. Because the CBN had already said they cannot buy their funds from the CBN Dutch Ocean market. So the window they have to exit is the interbank market. And interbank market froze. Because for the interbank market to function, for any bank to go into the bank market and buy funds, it means it has merged it out. And it may not be in all instances where as you are buying your fund, you also have somebody you're selling it to. So that created or completely diminished the liquidity in the interbank market, interbank forex market. And is that lack of liquidity in the interbank forex market we witnessed that JP Morgan is latching on to say that, look, your bond, your local currency bond no longer have liquidity for foreign portfolio investors because they cannot easily exit. But I'm happy Central Bank has restored 0.1% open position limit. I think at the meeting today and tomorrow, they should restore the 1%. I think 1% is actually a very small percentage of shareholders' fund that the bank can risk on FX trading.
So if that is restored now, what's going to be like the status of the market? Will it be more liquid?
I believe once you restore that 1% liquid, open position limit, you will restore liquidity into the interbank market.
Okay.
If you restore liquidity into the interbank market, you have restored liquidity on Nigerian bonds. Because the key thing is foreign, there must be free exit and free entry. Where you do not impose capital restrictions, but you have indirectly dried up the market, then you have effectively imposed capital restriction, which is what happened to them. And if they cannot easily exit, they certainly will not want to come in.
Okay,
and
so
that's
now,
why the bonds liquidity weakened.
So now let's look at the position of JP Morgan. They feel that in the best interest of their investors, they have to protect their investors and protect their integrity as well. And so they're saying that Nigeria is going to be placed on a watch of 3 to 5 months. But what is the implication if at the end of this 3 to 5 months assessment, Nigeria still we still do not have as much liquidity as JP Morgan is expecting of such a bond to have? What's the implication for Nigeria economy?
Well, if after 4 to 5 months we still don't have liquidity, JP Morgan may take us out of the emerging market local currency bond index. But I don't think that will be the case. I think if Central Bank Monetary Policy Committee restores the 1% open position limit, we may go back to our normal volume, at least something that approximates the normal volumes. Today, average interbank trade is between $20 and $30 million. It used to be between $300 and $500 million on a daily basis. So we are trading less than 10% of what we used to trade. Not necessarily because the instruments are not attractive. Today, the bonds, if you look at the last auction, last week bond auction, for FGN bond auction, the 2034 bond, the marginal rate was something like 15.8. I think 15.6. So you're already talking of instruments that are attractive. And at these rates, if oil price reverse, then these bonds will become very huge yield instrument for investors.
But Mr. Chukwu, you remember that at this time last year, nobody was talking about oil prices falling the way it has fallen. By June, we saw oil prices drop from $115 per barrel to where we are today, about $49 and still dropping. Now, in virtuality, nobody is saying that the central bank will not come up with enough policy measures to stem this seeming illiquidity or pressure that we're seeing at the forex market. But in the eventuality that something like that happens, how badly will it affect the strength and the viability of the bond?
Okay, there are certain things you do to manage your currency risk. One of which is to allow your currency to devalue. The second factor is that you can increase yield on your debt instruments. The federal government, like I said, the last auction, the 2034 bond, we saw bonds trading between 15.2 and 15.8 at the last auction. So that means the government is intentionally increasing yield to make Nigerian instruments attractive. See, you have to recognize the fact that, look, your currency weakened because your reserve was not huge enough. If your instrument becomes very attractive, it has its own cost, no doubt. But foreign portfolio investors will have, those who have volatile risk appetite will come for your instruments. And that will help stabilize your exchange rate. But the key thing, you must not shackle their exit window. You must not close the window for them to exit. If you close the window for them to exit, they will not even come in the first place. So if we allow for free entry and free exit, by allowing banks to play in the interbank market freely, using just 1% of their shareholders' fund as open position limit, you're going to have enough liquidity in the interbank market. That means anybody who wants to come in can easily buy money. Anybody who wants to come in can easily sell, because it means foreign portfolio investors that want to come into the country that are coming in with dollars will not have Nigerian banks to buy those funds from them unless Nigerian banks are able to match out those funds. And that was the problem of the zero open position limit. Let me put in a practical example. If a foreign portfolio investor is coming with $10 million, that means it's coming with about today is about 1.8 billion naira.
That's at 180 naira to the dollar.
At 180 naira to the dollar. Then, if he wants to buy a Nigerian debt instrument, he must get a Nigerian bank that will buy that money from foreign portfolio investor. The Nigerian bank must find somebody who wants immediate use of that dollar and must match out that same day. If they do not find a person who wants to take that money from them, they will not buy in the first place. And that was the problem of the zero open position limit, because they couldn't hold that money and wait for somebody to buy from them within maybe a 2 or 3 days period. It also follows that a foreign portfolio investor wants to exit the market and wants to buy dollar, basically he has made sales. He must have a bank who can buy that dollar from them, for them. And that bank must find somebody who is ready to sell, another bank who is ready to sell. That bank who is ready to sell must have been able to get a buyer. And because you must match out your position on a daily basis, it became a disincentive on the banks to take that risk because there was a penalty of taking that risk. And that ultimately dried up the liquidity in the market. And it's because of that liquidity, that lack of liquidity in the market, that JP Morgan is saying, look, you no longer have liquidity in your bond market and in your FS market. The FS market drove to some extent the liquidity in the bond market because the yield in the bond market is good. So if you have a good yield, then you must also complement it with liquidity, FS liquidity. But FS liquidity was what was lacking, and that was what led to this chain of events.
So the chain of events, did it actually domino into the Nigerian bond market as in?
Yes, absolutely, absolutely. Basically what happened was, because the bond market had lack liquidity, you had more people wanting to exit the market because they needed to take their money before further constraints are imposed on exit. And it automatically, when you have a lot of sell pressure, yield will move up, price will go down. And that's why we saw yield. We've seen yield currently trading about 15 point, at the height of 15.8.